Hi, I'm Pattu from freefincal. In this video, let's talk about how to get started with debt mutual funds. Many people are scared about debt mutual funds, but there's no need to be. There are some simple rules you can follow to start investing in debt mutual funds. Like I often say, debt mutual funds are special products. Today, you can avoid equity mutual funds and start investing in your own portfolio of stocks quite easily. It's become very easy to do that, but it's not easy to do that with bonds. Debt mutual funds offer you instruments that we cannot as retail investors so easily invest in, and also it brings you convenience. A bond offers you interest income twice a year, then that will be taxed as per slab and so on. All those hassles are avoided with debt mutual funds, but you have to have some care in selecting them. The first thing you need to understand is that the debt mutual fund is not a replacement for fixed deposits. People associated with AMCs will say all these things, but you should not believe that. A debt mutual fund NAV is linked to the market. The price of a bond will fluctuate, and all the prices of the prices of all the bonds in the portfolio will reflect in the NAV, and therefore there is absolutely no idea what the return will be. So of course it will not fluctuate as much as equity will, but there is a lot of uncertainty. When you compare it with the fixed deposit, there is a lot of uncertainty, and you have to accept that, and you have to choose it carefully. That's what I want to talk to you about. You make the choice carefully, and it will be quite easy to handle. Now, also, about 3 years for those in the 20% and 30% slabs or more, there are significant tax benefits for people who choose debt mutual funds instead of fixed deposits. I've talked about this several times in the past. Maybe it's time to do that again. I will give you an illustration maybe in other videos. Now, it's extremely important to understand that the bond market in India is getting deeper and deeper. That means more and more players are getting into the bond market. A lot of speculation is there in the bond market. Earlier, there was not this much speculation. So this means that even weeks or months before an RBI policy meeting, people will start speculating about what the repo rate will be, and the NAV of the debt mutual fund will reflect that speculation. So, for example, even before the first rate hike happened, the people expected that months earlier, and that was already priced in. That speculation, because of the speculation, the gilt mutual fund started falling several months before the actual rate hike happened. So all these theoretical ideas of how NAV reacts to rate cuts and so on, they're all theoretical, because now it has become heavily speculative. So we have to appreciate that, and we must understand that when there is sudden bad news, the stock market will crash. The same thing will happen to debt mutual funds. The same thing will happen to the bond market, and therefore it will reflect in the debt mutual fund now. Never ever chase returns in debt mutual funds. Never choose a debt mutual fund by looking at its returns or star ratings. And one thumb rule is, if the return is much higher, and that typically means that the risk in the portfolio is higher. Now, it seems crazy, but if a business is weak, and if they want to raise some money and they offer a bond, then the interest rate we demand from such a business is higher than let's say, a government bond. Already the company is weak. Already the repayment capacity is in question. But we demand extra interest rate because of the risk premiums. So it's very risky to choose bonds which are anything not supported by the government, directly or indirectly. If you choose such bonds, then there will always be a chance of default, even if it is initially AAA rated. We have seen cases where yesterday a bond was AAA rated, today it became A rated, and then it became just went straight to default. Within a matter of 1 or 2 days, or even immediately also it has happened. So the rating is just it's just some grade based on past performance. It doesn't really reflect what is happening in reality, and things change in real time. The rating will also change very fast, so you have to be very careful with it. If a bond defaults, the NAV of a debt mutual fund will fall by a large amount, and it will fall vertically. It will not even fall over a few days. It will just drop like like an earthquake, like a seismic shift, and it will not recover until the bond issuer repays. If in the meantime the AMC sells the bond, then the loss becomes permanent. So you have to understand these ideas and before you get into debt mutual funds. And please remember that sovereign rated bonds, that's not the highest rating. What it means is that you cannot really grade a sovereign rating. We just hope that the government will not fail. If the government fails, we will have much bigger problems than just poor debt mutual fund returns, but that's it. Then we must be aware about interest rate risk or duration risk. Higher the duration of a bond, the more volatile will be its price. The price will fluctuate a lot because there's a lot of uncertainty with respect to interest rates. There's a lot of speculation. So higher the duration of the bond, the more will be the volatility in the bond price. And this has to be kept in mind. You have to look at the portfolio carefully. You should not just look at the average credit rating or average duration. You must look at the distribution of bonds in the portfolio. Our monthly screener helps you to do that, or you have to look at the fund fact sheet. And a very simple thumb rule is that please look at the average portfolio maturity of the debt mutual fund as a first step. And that value, let's say an average the average maturity of the bonds in the portfolio is 1 year, then don't buy that debt fund if your need is next month or next couple of months or 6 months or so. You can buy it if your need is much higher than the average portfolio maturity. So if you want money after 5 years, you can choose debt mutual funds whose average portfolio maturity is much less than 5 years. Don't buy anything which is equal to 5 years or more than 5 years. This is the kind of advice that people give in the debt segment. They say if your need is 5 years, then your average maturity should also be 5 years. This is just bullshit advice. I've talked about this several times in the past. The volatility will always be there, and you cannot do that. If you want to have a really a fairly safe journey with peace of mind, your average portfolio maturity should be much lower than the tenure of your investment. I would recommend sticking to short-term funds with low credit risk, liquid funds or money market funds for less than 5 years, for goals less than 5 years away. It's very easy to choose funds in this category because the risk is fairly low. The credit risk is fairly low. Then you can also consider arbitrage mutual funds. Although they are not technically debt mutual funds, they also can invest in about 35% of bonds. They are considered as equity for taxation, and they have a typical, on a day-to-day basis, they have a volatility close to somewhere between money market funds and ultra short-term funds. You can also use them as the debt component in your portfolio. For long-term goals, you can use gilt mutual funds. I'm not talking about the constant 10-year maturity gilt funds, the normal gilt funds, which are also dynamic bond funds. You can use that, or if you don't like that much volatile NAV, you can choose only slightly lesser volatile funds like a corporate bond funds. These will also be volatile. They will also invest in long-term funds. There is a small chance of credit risk, but it's reasonable because most of the portfolio should be in AAA rated. You can accept that kind of a reasonable risk. So wherever you go, there has to be a trade-off. So these are, I would recommend only sticking to those 4 categories: liquid funds, short-term money market funds, liquid funds and money market funds for short-term goals. For long-term goals, use corporate bond funds or gilt funds. Any other category, I would say stay away from. You don't need any other category. That's all. That's just about what it is to choose a debt mutual funds. The thing is that you have to get used to the idea that it is not a fixed income instrument. It is actually a bond whose price fluctuates because of the supply and demand forces in the bond market. Once you get used to the idea, and once you choose a bond whose volatility is much lower than your tenure, so that is the average maturity is much lower than your tenure, I think you are fairly safe. Of course, the safety is not 100%, but it's quite reasonable.